Hey everyone, Couch Investor back to another video for today. So this is part one of a two-part series about fintech companies, more specifically fintech stocks, a recap of what has happened, of how they have performed in 2023 and what the market is expecting from those companies going into 2024, price targets, sales, EPS expectations, growth rates as well. We're going to go over 4 companies in this video and 4 companies in the other video. So it's going to be a full recap, a full deep dive into each and every company, because then these videos will be way too long. We've touched on all of these companies already on the channel, whether it's earnings report, news related. You can find those videos in the top right corner or just search on the channel. Now, do share your thoughts on what will happen with the fintech sector in 2024. I put my bets in that the fintech sector will outperform in 2024. Of course, rate cuts will help, but I think a lot of those companies, PayPal, Block, SoFi, etc., these types of companies have been beaten down quite hard, yet the business itself is doing quite well, so they should get some push from rate cuts, but also from a, let's say, better economic, macroeconomic environment as well. Now, I want to start with one company, not an American company actually, and that's StoneCo. Now, StoneCo has a market cap of $5.67 billion, a forward PE of 15.6 times. Year to date, it's up 94%, but the majority of that jump actually happened in the last 2-3 months. As you can see here, total returns 3 months, 72.7%. Quite a comeback. Now, if we look at the current valuation compared to its 5-year mean, we can see that currently PE is much lower than the 5-year mean, which was 40.4 times. Same with EV to EBITDA, very, very low, very, very cheap here at 4.1 times. Price to sales, just 2 times. Price to free cash flow, 15.7 times. So valuation-wise for this company currently, even though it is up 94.7% year to date, quite reasonable. If we look at a major overview of revenue, free cash flow, return on equity, gross profit margin, return on capital, we can see that over the past couple of years, this is in Brazilian reais, by the way, revenue has gone up quite significantly. We have become free cash flow positive on a fiscal year basis. Return on equity currently sits at 7.6%, but as you can see, back in 2022, we were in the negative. Gross profit margin has come down but is recovering in the last couple of quarters, and the same with return on capital, sitting now at 15.73%. Now, if we go and look at what the analysts are expecting the price targets for the next 12 months, currently the average price target sits 9.85% lower than the price we're at today. Of course, with this stock being up so much in a short period of time, that was bound to happen, but price targets change when new earnings reports come out. Usually, analysts adjust their price target. Now, what are the analysts expecting when it comes to sales and EPS growth? Well, if we look at fiscal year 2023, year-over-year growth for sales 37.6%, EPS 174.92% year-over-year growth. So that's why you're also seeing the forward PE still being quite reasonable here, despite the stock being up a lot. Fiscal year 2024. 10% year-over-year growth with regards to sales, but another 34.5% growth year-over-year for EPS. And in fiscal year 2025, we are slowing down with sales growth, 8.72%, but EPS growing faster at close to 17% year-over-year. And as you can see here from the graph, the majority of the jump came since the end of October. Stock is up close to 90%, but if you look at on the weekly chart, it is being overbought right now. So maybe you can expect a pullback. We've seen the same thing happen with another fintech company, which is Adyen, went up 90%, overbought, and then tracked back just a little bit. So that was company number 1, StoneCo. If you want to learn more about what they're doing, that video will be in the top right corner. Now, before jumping into company number 2, if you like this type of videos, leave it a thumbs up, subscribe if you have not. We'll really appreciate that. And thank you to the new member, Thomas R. Thank you for deciding to support this channel. If you want to support me even further, do check out the links down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So company now number 2 is on the best stocks to buy for 2024 list. It's a company we've been talking about for quite a while now, and that's PayPal. PayPal currently a forward PE of just 11.7 times, has a market cap of $68.3 billion. Year to date, the stock is down 11%. Now here, we've seen these numbers already a couple of times on the channel, so everything here. Forward PE, EV to EBITDA, price to sales, much lower than the 5-year mean. Price to free cash flow, 21.4 times, very, very cheap for this type of company. Then if we look at shares outstanding, that has been coming down for the last couple of years quite heavily because this company is still generating billions of dollars in free cash flow, so they can buy back their own shares quite a lot. You can see that in the last couple of years, free cash flow per share has increased a lot. It can do better, and I expect it to do better as this company becomes a leaner, more profitable company and growth reaccelerates. We should see more than those $5 billion, $4 to $5 billion in free cash flow in the coming years. The expectations here, the EPS estimates on the 5-year growth rate sits at 15.44%. If we look at what the analysts are expecting their price target for the next 12 months, the average price sits at $76.5, which means they are seeing here a 20.8% upside to the stock in the next 12 months. Now, what else are they expecting with regards to sales growth and EPS? So for fiscal year 2023, sales growth of just 7.6%, but EPS is expected to grow much faster, 20.4% year over year. Fiscal year 2024, acceleration of growth with regards to sales, 8.6% year over year growth. EPS should grow 12.47% in fiscal year 2025, same growth rate as in fiscal year 24 for sales, and then EPS another 11.12% year over year growth. But in my opinion, I think these numbers will change quite dramatically. We're going to see the direction the company is going in the coming quarters or two. New management, new excitement around this company, especially with the new CEO, new business segments that have been put in to reorganize the way this company is operating. They've got a great product despite what a lot of people have been saying. They've got a great product. Lots and lots of people are using PayPal. Transaction margins next quarter probably down again, but should improve from there. This company, again, fundamentally very, very strong, just bad management, especially coming out of the pandemic. When you've got great products, yes, sometimes bad management can ruin a great investment, but for long-term investors, this might be a huge new opportunity for plenty of upside. So had to put PayPal here in that list. Oh, by the way, I almost forgot to put the PayPal graph. So having here a quick look at PayPal, we can see that the previous support, which did not hold back in September, got right now broken through. We're making our way actually to the 200-day moving average, which sits at $65. RSI is still pretty neutral. We are having the momentum right now with us. Let's see if we can break through the 200-day moving average. If not, let's see how that support line back at $60 holds up. Now, company number 3 is another company in Latin America, and that's one of my favorite holdings from that area. Number 1 is obviously Mercado Libre, but number 2, not far behind, is this great company called New Holdings. New Bank has a market cap of close to $40 billion. Year to date, it's up 105.2%. Has a forward PE of 23.5 times compared to its mean of 85.1 times. What is happening here? Well, this company is just growing extremely fast, top and bottom line. So despite the stock being up this year that much, fundamentally the business is doing also much, much better. Price to sales 3.9 times compared to 6.9 times. And then price to free cash flow just 20.2 times compared to the means. This is, in this case, the last 2 years, 31.9 times. Here we can see the same thing. Over the years, revenue has grown quite fast. Free cash flow, we had a bad year back in 2021, but other than that, free cash flow has been positive. Return on equity has been going up, now close to 7% in the last 12 months. Gross profit margin here, well, it sits at 100%, but I don't think it's that number. And with regards to the price target, despite the stock being up 105% year to date, the average price target sits at $10, which means 20.3% upside from the price we're at today. And if we're looking at what the analysts are expecting for the next coming fiscal years, I mean, this is just tremendous growth. top and bottom line. Fiscal year 2023, year-over-year growth for sales, 66.83%. EPS, 454.6%. Fiscal year 2024, sales growth year-over-year, 36%. EPS, 65% growth year-over-year. Then fiscal year 2025, another close to 30% growth year-over-year for sales, and for EPS, another close to 50% growth. This company is just executing remarkably. Management, top class, business, top business as well, in despite the risk and a couple of orange flags in that area, they're doing extremely well. Now, looking at the graph for new holdings, you can see that the big push here has happened since March. March, we were at $4.5. Then we made our way back up to $8 or so. That was a resistance. Then we went back down to around $7. We stayed there for a couple of weeks. Could be a nice support area if something bad happens. But then we made our way back up to around $8.5. Got rejected there, but we stayed above that 50 and the 20-day moving average. Currently, the 200-day moving average sits at $7.23. RSI is pretty high, but unlike back in July, we are not overbought. Up next, company number 4 is a company that has gotten a lot of attention in recent weeks and months, and that's the buy now, pay later company Affirm. Now, Affirm was another one of those pandemic darlings. We've talked about Affirm and a competitor of them, Klarna, maybe going public next year in that IPO video. That video will be in top right corner. Right now, Affirm market cap of $15.31 billion. Year to date, it's up 424.87%. In the last 3 months, it's up 143.4%. Now here, there is no PE right now. We just have a price to sales ratio, which is pretty high, still 7.3 times. Now, it's true that revenue has been increasing for the last couple of years, but the company is still not profitable, and you will see soon that the expectations of profitability are still not there for next year or fiscal year after that. Return on equity is still pretty negative, 35.3%. Gross profit margin has actually come down in the last couple of quarters. Return on capital is lower than before, but we are seeing a little rebound in the last couple of quarters. Now, what are the analysts expecting? Well, it does not surprise me that the average price target right now sits at $28.68, which means downside of 43.4%. Of course, if next earnings report is very, very good and outlook is very, very good, I do expect those price targets to be revised on the upside. Now, there is a reason why Affirm stock was pushed so high. I mean, if you look at the graph, we've got a huge push since the end of October. It's up close to 200%. Now, with regards to buy now, pay later, you can see here the share of US buy now, pay later users who have used the following buy now, pay later providers in the past 12 months. Not surprised here. PayPal, number 1 by far. Afterpay, that's a block company. Number 2, Affirm sits at number 3 at 21.9%. Now, Affirm itself got a downgrade from Morgan Stanley, saying that the risk-reward appears skewed to the downside at current levels, even with pending strength through a seasonally strong holiday period. While we believe Affirm is executing well amid its goal of becoming a more meaningful player in the payment landscape at $44, right now $50, we believe the market has gotten ahead of itself. They finished off by saying that valuation seems difficult to justify across all metrics. Now, of course, this company had a lot of positive announcements. Affirm expands to self-checkout at Walmart stores. We also had an announcement with Amazon back at the beginning of November. So definitely a lot of positive news with Black Friday, Cyber Monday sales. We've talked about that on the channel as well. Pretty positive for players like Affirm. It also has a short interest, I believe, close to between 15 and 20% last time I checked. So that definitely helped push the stock higher as well. And here we can see what the analysts are expecting. So again, if you look at EPS, I mean, until fiscal year 2026, it is still negative. So that's not great news for investors. Yes, the top line is growing above 20% year over year, fiscal year 24, 25, and 26. So top line is not an issue here. Bottom line is. And so to conclude, in my opinion, out of the 4 companies, of course, this company is the one that you just put on your watch list. In my opinion, great CEO, great product as well, but right now at this price, it just doesn't make any sense, even if the current quarter is a great one. It will take a quarter or 2 or 3 until valuation catch up to that price. Of course, this is just my opinion. Share your thoughts down in the comments below. Again, this is just part 1. Part 2 will have the other companies, SoFi, Block, Adyen, Robinhood, stuff like that. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.